Hello and welcome to this week's instalment of Nucleus Investment Insights. We have another special guest this week in Graham Hand. Graham joins us to share his thoughts on what has been a truly revealing and well overdue Royal Commission into the misconduct in the banking, superannuation and financial services industry. Over his 42 years of experience in financial markets, Graham has worked in a myriad of senior roles across a number of major banks, including the Commonwealth Bank and the State Bank of New South Wales. A terrific summation of his observations over that time were encapsulated in his 2001 book, Naked Among Cannibals, which provided a rare insight into the murky world of bank privatisations. From there, Graham embarked on full-time writing and consultancy roles with columns and articles in publications such as CFO Magazine, Euro Money, Money Management, Crikey and Banking Day. Currently, Graham is the managing editor of the very popular Cuffelinks independent financial publishing house that aims to share both the knowledge and battle scars of experience from leading minds in the industry. After the interview, we will then look at some of the wider investment implications that these themes can impact on how we invest money every day at Nucleus Wealth. So join Nucleus Wealth's Head of Investments, Damien Klassen, and myself as we learn more about the real impacts of the recent Royal Commission on everyday Australians and the broader economy. I hope you enjoy. So today on the podcast, we have bank veteran, author, and now managing editor of the highly regarded Cuffelinks newsletter, Graham Hand. Welcome to Nucleus Investment Insights, Graham.
Great, thanks very much for the invitation.
So Graham, after 18 odd months of debating in Parliament as to whether or not we should even have a Royal Commission, we've now had public hearings over 68 days, over 130 witnesses and 10,000 public submissions provided. We've seen a number of banking elite heads roll, hospitalisations both physically and also career-wise, and now, of course, a report telling us, in essence, that it's potentially the fault of the regulators and mortgage brokers. I guess, given your depth of experience and knowledge of bank culture, is this the Royal Commission that you could have hoped for?
Well, the actual hearings were great theatre. I really have enjoyed the last year, and as a publisher, and our readers have sort of loved following the content. And I know a lot of people are now saying, well, that was a very informative year of all sorts of dastardly revelations, and the final result is less than people expected. I'm not going to give judgment just yet. I think that the big call that Hayne is making is what happens now with the regulators. And he's largely thrown it to APRA and ASIC and also Graham Samuel's role to really make things happen. And that's the big call for me.
Okay, sure. And I guess sort of moving on for that, do you feel that there's a sort of a political part to play now in terms of, and obviously we've seen the current government essentially agree to all, 76 recommendations, and we're not too sure how much of the rubber will hit the road there. But is this now where I guess an ensuring party that may be coming into power, can now continue the work or could build on where the Liberals have sort of perhaps paid a little bit of lip service?
Yeah, and the politics are fascinating. I mean, we do know the Liberal Party fought against parts of the FOFA legislation going back to 2012, and certainly the Labor Party will make political mileage of the oft-repeated 26 times that Scott Morrison said we didn't need a Royal Commission. But I think both parties will go through this next election campaign with a sort of tough on crime mantra, and they will talk about adopting it. And, there's some weasel words going on about in principle and take action on. And so, most things won't happen before the election. And typical in politics and in social commentary, how much will the blowtorch still be on these issues come June and July? And I'm certainly hoping that it is, because what was the last year about if it wasn't that we actually end up with some changes. So the politics, we certainly haven't heard the last of it.
Absolutely.
I guess structurally, from my point of view, it's hard to put my finger on what's fundamentally going to change, though. I guess I sort of look at this thing and go, well, what's to stop sort of in 5 years' time a new appointee of ASIC or APRA who has the feeling that, hey, things have been pretty good for the last, for the last 5 years since the last Royal Commission, and let's go with a light touch version and let's sort of scale back on some of the oversight with I guess appointed that with at the behest of whatever the government is at the time, who might be influenced by lobbyists, and we could sort of just see a replay of it, the whole thing all through again. I guess there doesn't seem to be any sort of major structural changes being made, or am I being, I guess, too pessimistic on that?
Yeah, look, it's a good point. The sentence in the final report, which I'm drawing comfort from, and I hope that people continue to focus on it, is Hayne talks quite a bit about Section 1041G of the Corporations Act. Now, I don't want to sort of bore people with the technicalities, but if you actually see, he spends a lot of time on 1041G, and I'm hoping that this becomes one of those clauses that people often quote. And what this clause says is it prohibits engaging in dishonest conduct in relation to a financial product or financial service. So one of the points he makes is we don't need new laws. There are existing laws that people have breached. And then he goes on to say, for example, in his opinion, taking money for nothing, as in fees for no service, is dishonest conduct. So he's saying to ASIC, in my opinion, and he's an esteemed judge, there is already breaking of the law. Now, that's pretty strong stuff. And if ASIC, with its additional funding and having been wrapped over the knuckles for the last year, if ASIC and the government don't act on him saying they've already broken the law, then the whole thing has been a waste of time. So you're certainly right about what structural change is there, but he is saying that the law has been broken, and there's a great line. He just says, I don't get it. Why not litigate? Why not litigate? If someone has broken the law, don't you litigate? You don't go in and say, let's have an enforceable undertaking, and by the way, here's a $1 million fine. So culture is a sort of a nebulous thing, difficult to put your arms on, but that's pretty strong.
Yeah, because my take's been that unless people go to jail, it's pretty. The next generation of executives won't remember. They'll be along the lines of saying, well, some people did some bad stuff, and the shareholders paid a fine for it, and the executives involved got a big bonus and got wrapped over the knuckles, and then they off they went. And if the next generation is saying, well, remember 5 years ago all those people went to jail, then I'll make sure I'm not going to jail. But if they're looking back saying, yeah, look at all those people who got wrapped over the knuckles and got large bonuses that they got to keep and golden parachutes, then the incentives are still there. So I guess are you expecting people to be jailed, or is it going to be a shaking the finger and you've been very naughty, don't do it again, and next time we'll definitely throw the book at the next person who does it, but you managed to get away with it this time?
Look, whether a court ultimately agrees with Hayne and decides to imprison an individual, that's going to be a drawn-out story. But can you imagine if you're James Shipton, head of ASIC, given what has happened in the last 6 months, and would you go after someone? I reckon you would. You now have to litigate. You now have to. Kenneth Hayne has told you, taking money for nothing is dishonest conduct. So ultimately, the courts will decide, but I reckon that they will go after someone.
And I guess could we put a plural on that? Some ones, I suppose, because that's and I guess because it's sort of Yeah, and someone senior, I guess, is the important point as well. Is it's one thing to say, look, here was somebody who, was involved in dishonest conduct at a lower level of a bank and should have known better and whatever, versus he was, systemically taking money from clients who didn't deserve to pay, and clearly senior management knew about this and decided to go slowly or to put it off until later. I mean, that's the part where I still haven't had the feeling that's going to happen. But that is where I guess I'm tossing it back to you. Do you think it will be a senior, or do you think there'll be a few sort of lower level people sort of thrown to the wolves?
Yeah, look, with it throughout the Royal Commission, there were a few big moments that really made people realise this is pretty serious. This isn't just a sort of general inquiry, and one of those moments was when I think Nicole Smith, the lady's name who was a Nucleus trustee, and Kenneth Hayne interrupted the counsel assisting and said quite directly to her, "Did you ever think that was a criminal offence?" And she sort of did a double take and said, "No, it never occurred to me." So look, if ASIC was to decide that you need to get a big scalp, then it could be at the top level, and it'd probably be a pity if the Nicole Smiths of the world are the ones that are targeted.
Yeah, that's where I guess my take is. There's one side to say, okay, here's a bunch of trustees who should have had more oversight, versus saying, well, here was a CEO who pressured the trustee to push this through. And I guess the question is, if it's a compliance officer at the trustee level who's going to jail, that's sort of one's obviously it is a disincentive going forward. But if it's a CEO pressuring, then that seems to be, to me, a bigger disincentive that still seems to be unlikely.
Well, and is it simply a case of the fish rotting from the head down, sort of, to use that analogy, in the sense that, and look, and you'd know a lot more than I would, I guess, Graham, in the banking world and in terms of culture. But even from my own experience working with large licensees, you've got your sort of typical climber person who moves through position to position and fulfills their role and does what's expected of them to meet their targets so they get the next promotion. Whether or not that's the right thing to do or legal at the time, I guess, is a problem for the next person because they've moved on. Is that sort of part of that systemic sort of culture issue that you think belies the big banks, Graham?
Look, it's a fascinating issue about how a bank's structured, how a decision's made. If you look at someone like the Commonwealth Bank, there's 50,000 employees. Now you can say, okay, a lot of those are tellers and they're just going through a process, but there's a lot of people who are making decisions which affect the lives of thousands or millions of people. And the aspect of that always comes to mind to me is the bank pricing committee. Now, I've sat on 3 pricing committees, and I think that if you heard some of the things that went on in those committees, then almost anyone would be embarrassed who was at a board or a senior executive level. Let's face it, you're sitting there and you're literally deciding, what should the home loan rates be? What should deposit rates be? How do we price credit cards? And that's really where the rubber hits the road. That's really what culture is about. And the boards of the banks can sort of sit around and say, we need to have multiple stakeholders. We need to put our clients first. But what happens at that meeting? And if I had any CEO in the room, I would say to them, how often have you attended your pricing committee? Do you know what actually happens there? And I wrote an article about this about 6 months ago when I'd been to a talk by Ken Henry. And, this is well before we knew how strong the Royal Commission was going to be in its findings. And if you'd have heard Ken speak about, trust and winning back the community, you would say all the noises were absolutely right. And then I say, well, but what has actually changed in the day-to-day operation of the bank? And that's, for me, that's what culture is. It's not what you say, it's what you do. And I mean, I can give you a couple of examples if you're interested. But that's the big step. You know, why has Ken been the chairman since 2015? And there's this perception that NAB really hasn't changed, and it's difficult to change the way 50,000 people behave.
Okay, yeah, sure. Actually, yeah, I would love some examples if you've got something there, just to sort of, I guess, give some context.
Yeah. So look, I'll just give a very simple couple of examples of the way it works. Now, let's just take term deposits, right? They're one of the most common transactions that people have with banks, and really dwarfs any of this fees for dead people that everyone gets worked up about. That's a minor issue compared to the millions of people who have term deposits, often older people living off them. And what happens in the bank is there's a conscious decision to try and roll over term deposits at a lower rate than the market rate. And it means that when you have a term deposit rolling over, you know that if you offer a person a lower rate on the rollover, 99% of them won't do anything about it. It will just roll over. So if the market rate is 2.5%, or you're willing to pay 2.5% for 90 days, but you know in the billions that roll over every month, if you offer 2%, they'll just roll over. Well, what do you think happens? You know, at a pricing committee, there's actually tables of when do the rollovers happen? What is the maturity of the rollover? How do we set our rates to reduce the cost? And it means that the person who's living off the term deposits, who doesn't do anything about it, gets a lower rate than they should. And very often, you know, this is a 90-year-old who just either doesn't know it's happening or can't be bothered making a phone call. I mean, there's a subset of the policy is that if you do get a rollover at 2% and you ring the branch and ask for 2.5%, you get your 2.5%. So, but that's not the issue. We used to call it retail inertia. And you know, so that's sort of, I'd say, shouldn't you be offering the market rate without hoping the person doesn't even notice?
Yeah.
And you know, there are lots of things like that, the way the pricing committee behaves.
And it sort of speaks a little bit to the once again going back to the culture I guess the way you treat your customers, essentially, where your existing customers are automatically disadvantaged purely by being a customer and not being a new entrant to the books, so to speak. So yeah, that's fascinating. Thanks for that.
Changing tack a little bit. One of the things that sort of, I guess, from a little bit of a distance, it appeared to me that a big factor in how companies came out of the Royal Commission seemed to be how contrite they were about the whole situation, rather than what they'd done. So I guess I'd probably use the three examples of Dover, IOOF, and National Australia Bank, which seemed to be the ones that he came down hardest upon. And they also seem to be the ones that the least contrite about rather than potentially the ones that were involved in the worst activity. That seemed to be some of the ones that turned up with quite bad activity, but seemed to be seemed to be very very contrite about the whole situation. Seemed to get away with less of a mention from him. Would that be your impression as well?
Yeah, I think you're absolutely right, and is that the way it should be? I mean, surely the end result must be, what are people doing, not what did they say in 1 hour in a witness box. And the classic example is Ken Henry, right? So let's just examine that for a minute. Ken Henry was Secretary of the Treasury for 10 years. In that time, every 6 months, he had to appear before the Senate Estimates Committee, which is a lot of sort of opposition senators. And so that's like, I think, 23 appearances faced by senators like Matthias Coman and Eric Betts. And it was sort of an argument between the two, all about the country's finances and the way money is being spent. And so Ken has that environment. He's had arguments and worked with Paul Keating, John Howard. I went to university with Ken, so I know him very well. I don't know him very well. I'm not going to pretend we were close, but he's a formidable person with an extraordinary career behind him. And here is the counsel assisting the Royal Commission who asked him a question, and he a question like should the board have done better, and Ken says, I wish we had. And Rowena Orr then says, you haven't answered my question, is that yes or no? Now I ask you, wasn't Ken's answer a reasonable question, a reasonable answer? He said, I wish we'd done better. Rowena says, is that yes or no? So then Ken says, I think I've answered that question. And she says, no, you didn't. Is it yes or no? And really, the point Ken missed, and he no doubt regrets it now, is he's had 20 or 30 years of sparring with intelligent people where he gave as good as he got. And here he was in Kenneth Haynes' court. He didn't play the game the way other people did, who just said yes, no, and just sort of cowered to it. Now, did he make a mistake? Yes, he's lost his job. Was he bombastic? Yes, he was. So that wasn't very clever. But should he be hung, drawn, and quartered because of that? I don't think so. And I probably listened to 100 hours of the Royal Commission. There were some times when other executives were just lying down. I was thinking, come on, defend your business, for goodness sake. You made these decisions, defend what you did. And so I think there is a bit of what you say. I'm not criticizing the Royal Commission. People should have understood what it was. Ken made a mistake. But let's not now make the decisions based on how a person performed in an hour or two in a witness box.
Yeah, that's my issue. Is that there seem to be some banks, and without naming too many names, but I think just on the raw face of it, it seems like Commonwealth Bank seemed to answer a lot more questions about the structure of its business, and the AMP obviously answered a lot more questions. And I guess the AMP lost their executives early, but that seemed to be in the final report seemed not to come out. But I guess and looping that back around then. So in terms of, I guess the key thing for me as an investor looking through the Royal Commission is taking the view on two parts. One is the effect on banks' business models and structural changes they'll need to make, and then the second part is the effect on the lending market and credit availability for the broader economy. So sort of stepping back to the first bit, this effect on the business models. We spoke a bit about the existing laws and things like that, and no sort of direct thing about structural separation, say of trustees or of financial planning. So I guess from that perspective, as a broad brush effect on the bank's business models, there doesn't seem to be a lot of lasting issues, I guess, which is, in my view, why the banks did rally on the day. Would that be similar to what you're seeing?
Yeah, I think that there's no big, profound recommendation on separating of businesses. Look, I guess the big one that we should discuss in that context is vertical integration, and I probably have a slightly different view on this. So by all means, push back on me. But I think if you work in the wealth management business of a bank, it should be possible for you to distribute your products through the bank network. And I think if if banks step away from financial advice completely, then I do worry about how most Australians are going to get financial advice. And I think the majority of people should get financial advice, certainly in their latter years, when they are going into retirement, changing lifestyles. Financial advice is really important. And I mean, you guys know more about financial advice than I do, but this is an industry. Let's call it a $300 an hour industry. Let's say a statement of advice takes 10 hours. That's $3,000. Most people won't pay $3,000 for financial advice. And yet they need financial advice. And this is the issue we've all been struggling with. So the solutions in a vertically integrated model is that you embed some of that payment into the product, and there you have a conflict of interest. So I understand all of that. Briefly, what my solution would be to say that if you say to the customer, okay, you're a Commonwealth Bank customer, you came into a Commonwealth Bank branch to speak to a Commonwealth Bank teller, and I'm showing you a Commonwealth Bank financial advisor. In order for us to provide this service, we're going to sell you a Commonwealth Bank product. We promise you that it will be competitively priced and it will be a quality product. Now, we're not saying it's the cheapest in the market. We're saying it's a very competitive offering, but we're selling our own product. Are you happy with that? And I reckon 90% of people would say, fine. I come in here and I get a home loan from you. And I think the fiduciary responsibility could be handled. And it would be a pity if the bank stepped away from that. And I understand that people would say, well, there's a conflict, you're flogging your own product. I just think it was manageable. But I know not everyone agrees with that.
Yeah, well, it's an interesting one for mine, in the sense that it needs to, like anything, I guess, that it's buyer beware, but you need to be told. And I think you've sort of touched on this in a couple of articles as well, where a person, and it probably exists maybe a possibility for a demarcation of the way advice is provided. So, and we used the example in the past of, say, when you go into a Ford dealership, for example, and you're going to walk out with a Ford, but you go in there, you say, I'd like to buy a car. These are my requirements. These are my needs. I want you to use the internal knowledge you've got of your product set to provide something that then gives me exactly what I'm looking for, and I know it's going to be a Ford. And then off you go. Where I guess the lines get a little bit blurred now is that with the FOFA reforms that came out many, many years ago, that ultimately now a person's essentially told, well, look, I can provide you advice on a number of different products and a number of different providers, even though I'm paid by one specific provider at the moment. I'll turn a blind eye to the fact that I've got this connection, and we'll go out there and find something. And then lo and behold, as it turns out, through the Royal Commission and many other studies have done, that the majority of the advice typically will lend towards the person who's at the top, who's paying the piper. So where do you see that sort of going? And I know you've touched on lack of independence, or there is a lack of independence declaration that was nominated by Mr. Hayne. And do you see any sort of meaningful change to the way that advice is provided in Australia, given the outcome of the Royal RC?
Yeah, so you're right. One of the recommendations was that an advisor who is not considered independent has to hand a piece of paper to the client. And it's clear that Kenneth Hayne has formed the view that large institutions have an inability to manage conflicts of interest. And so that's a real problem for the vertical integration model. I would like to think that there are products in most wealth management businesses that are defendable and could be sold, but I know the evidence is not good. I would prefer the banks not to step away from the wealth management businesses. I don't want financial advice to become the realm of the wealthy person. I really think it's very important for people to become financially educated. I would love Hayne to have said, the way to avoid these problems in the future is that we have a more financially educated population. The government should allocate 500 million to financial literacy, and then we might have been on our way to a long-term solution.
Okay. Yeah, my other take as well, sort of to wrap that up quickly, is just to say that I think the pushback I have is that I think people can sell. I think you're right that banks can say, here's a product. We've got these products, and I think this product's the best for you based on all these things. I think the big problem comes is that for the most part, it's the switching that where the issue is because it's basically saying, well, you're already paying somebody else, and I want that money myself within my bank, and so I will go and tell you that to get out of some other product which might actually be better for you, and get into my product which may or may not be better, but with a glass half full, you'll always think it's that way, and I think that's the part where, for me, if you prevented that sort of class of people from giving that advice, and basically so having to say up front, I cannot tell you anything about your existing stuff. If you want someone to give you that, you need to go to an independent person who can look at both products and make a choice. But I could definitely tell you the best product to get into in the Commonwealth Bank, and I think that would sort of get rid of a lot of those conflicts.
Yeah, I mean, getting rid of conflicts in the entire finance industry is incredibly difficult, and one of the ones that comes to mind for me that I've also written about is the way IPOs are done and the way commissions are paid by the issuer of an IPO, particularly, say, a listed investment company, which is just a managed fund by another name, and that they have selling fees which are paid to the brokers, and the brokers can then share them with the financial advisors, and the financial advisor may keep it or may share it with the clients. Now, there's nothing about that in the Royal Commission. It's a commission by another name. This overall, the industry is, you close one door, I'll find a way of opening another. So, we've okay, if we stand down on this, what else will happen somewhere else?
Yeah. Well, I think you're preaching to the converted on that side. I think the structure of those, as a fund manager ourselves, I think listed investment companies are fantastic for us, but for the actual client on the other end of it is the outcome is nowhere near as good. I think you basically, and they don't know that's it's been sold to them because it's got a fee on it, and so that's why they've pushed the listed investment company, because they get a fee rather than pushing a managed fund, and then you run the whole problem, obviously, of when things go wrong and you do want your money back, is that often you're trading it at a discount, and
I was going to perhaps move across into the sort of credit and mortgage, and I know Damien touched on it before.
So I might preface this by sort of our view of the world, and I guess looking for your pushback against this, is that as I said, there's sort of there's the two main parts as an investor. Is one, in the effect on business models, where I'm saying no, I don't think there is a major effect. Second part is, what's the effect on the economy from the lending standards? So we've seen a big increase in lending standards from the start of the Royal Commission, as banks trying to get in front of potential issues. That sort of focused around the HEM and basically a calculation that banks were doing, where they'd put customers onto I think it's the 25th percentile of expenses, and basically just assume everyone was on that, and use that to assess how much of a loan they could take. And the issue the Royal Commission came back with was that's not what you're meant to be doing. You're meant to be working out whether you can whether customers can actually pay the loan or not. And so taking somebody who's got kids in private schools and foreign holidays and all these other expenses that they spend, and assuming that they're going to live on almost the poverty line is not right. And so, okay, so that's the sort of background for readers. I guess my question is, and our view is that pullback has been enough to push the housing market down, and that that Hayne didn't actually come out and make a ruling either way, but he rather pushed it onto this next court case. He indicated, I think, that he thought the right way was that banks would need to do more work, but the fact he's pushed it onto a court case, which has still got a time to come, seems to say to me that the banks will actually hold back on their lending until they actually get clarity from this court case between Westpac and ASIC that's going on at the moment. And so I guess I'm passing that back to you, Graham.
Yeah.
So my view is it's still a weak housing market. It's still or a negative housing market, and it's still credit restrictions until we see the result of that next court case at best.
Yeah, and this is one of those be careful what you wish for consequences. There's no doubt the banks were lax. HEM is a good example. A lot of people could borrow easily, and we've ended up with the world's highest household debt to GDP ratio. And we had between 2012 and 2017, this amazing run in housing. It's gone almost completely the other way now. You probably rank it as an overreaction by the banks. Someone was telling me that 40% of the loans that he would have written a year ago are now being knocked back, and whereas an application is taking 3 or 4 times longer to put together with far more details, gym memberships, and do you subscribe to food services? So it's gone completely it's gone a long way the other way, and I think it'll gradually work its way back. I think banks still want to lend to good borrowers. That's the nature of their business, particularly since the banks will increasingly become more like building societies. They're stepping away from wealth management. They probably do less on the corporate side. And the worry in all of these circumstances is what fills the hole. Nature abhors a vacuum. If there are borrowers, someone will step into it. So if that becomes the rise of poorly capitalized fintechs who are lending to people at 15% instead of the banks lending to them at 7%, you can say, okay, well, we fixed the banking problem. Yeah, but what about the shadow banking problem? And then in years to come, you'll have a shadow banking problem. And so my hope, maybe wishful thinking, is the banks will find a middle ground between these two extremes. And I really can't see them going back to what you might call the bad old days of lending to people without the more rigorous checking that they're having now.
But I guess from we've got the Prime Minister and the RBA and a number of people out there exhorting banks to get out and lend, and over the last few months, and the banks haven't been with the quite reasonable position that we want to work out what comes out of the Royal Commission first before we work out, because if this is deemed illegal and predatory lending, then there's more sort of again possible jail time and various issues around that. And so with Justice Hayne putting it off to this ASIC versus Westpac case, from the banking perspective, doesn't that just prolong the period where you're saying, well, I still don't know what the rules are, so I should err on the side of caution in terms of what I'm lending, just in case this court case does come out and say, hey, this is predatory lending, and what you guys have been doing, has jail sentences as a possible outcome.
Yeah, if the banks do delay further, you're absolutely right. And I guess this is a subset of the criticism of Hayne, in the same way he's passed other issues to ASIC to prosecute. He has said to ASIC that on its face, my opinion is, and now go get them. And this is another example of this. So there's no answer until all that plays out.
Yeah.
Okay, sure. So look, I guess just broadly speaking, the outlook on credit creation, and as we've touched on there, is potentially going to be limited. Impacts, I guess, on bank profitability, and I guess from our point of view, from an investment point of view, the long run sort of earnings and whatnot. Do you think we've got some hiccups coming in the next couple of earnings periods as some of this Royal Commission starts to shake out, or do you think it's largely priced in?
It's very difficult to know what's priced into bank prices, as you know. The Commonwealth Bank has been nearly $100 now. It's 70, and so what's priced in at any point in time. What you can be very confident about is, I think, two additional costs the banks have to live with. One, massive compliance and legal bills, which big numbers, and big numbers for remediation costs. So what's 500 million to the Commonwealth Bank? It's obviously painful, but in the course of a year's profit, certainly manageable. So how much is it built in? What worries me more, and I've talked to people who work in banks in the last 6 to 12 months, is that innovation is being stifled. Creativity is being questioned. Can you imagine trying to develop a new product in a bank at the moment? You have got so many people crawling all over you about compliance and legal, and compared to what we used to do 10 or 20 years ago, where sometimes business isn't certain. Sometimes you just got to have a go. Sometimes you're not sure whether the design is perfect. And I think that the issue of to the extent that bank growth comes from innovation, I think we're going to have banks becoming more like utilities. They borrow and they lend and they provide transaction services. They don't do wealth management. They don't do investment banking. They don't do any of what you might think of the sort of more innovative side of things. So look, I'm not a financial analyst, but I think there's a good chance that in the next 5 years, banks are fairly boring businesses. And if you want to have a steady dividend stream, you're probably okay. If you're expecting capital growth, you might be disappointed. What do you guys think?
Oh, look, my take is it all comes back to the housing market. I think I think you're right that they will end up being a lot more utility-like, which is a good thing from, I think, society's point of view, and probably as a shareholder as well. I'd prefer to know that here's my banks that are safe and stable and cruising along, and then here, if you want some exciting stuff, here's some whatever it is, fintechs or other wealth management companies. But I think the bigger issue for my part, for the banks over the next few years is, well, certainly over the next sort of 12 to 24 months, is that it all comes down to the housing market, that they're extremely exposed. And if you're if the outcome is that there's credit rationing going on and house prices continue to fall, then the banks are one of the places you prefer not to be under that environment.
Yeah, sure. So, look, just in the interest of time, Graham, I thought obviously we've covered in depth somewhat, and I think we could go on for another hour or two. The remaining sort of components of the Royal Commission. What I'd be interested in just quickly hearing about, though, are some of the things that were potentially missing from this Royal Commission, and by way of omissions, I think you popped out a post on Cuffelinks recently on some of the key areas that you perhaps were looking for that were sadly lacking. Do you mind just sort of covering off on some of those and some of the potential impacts that those being missing may have on the economy?
Yeah, so a few areas that I looked at. If you go to the index page of the final report and you look under banking, it strikes you how little is there. It's nothing. There's nothing about transaction banking, foreign exchange, as I've said, pricing of products, credit cards. There actually is not that much there on banking. Now, you can say they had limited time, and we can discuss whether they spent too much time on particular issues. So there's a wide range of other things, and my issue would be, do banks now just focus on the things that Kenneth Hayne identified because they are the ones where the recommendations are? And I say, okay, well, what about everything else? Think about what a bank does. And just because Kenneth Hayne didn't look at them, don't mean all those things were right. So that's the first thing that really struck me. We haven't really spent much time on mortgage brokers, and I would say that Kenneth Hayne was overly critical of that industry. Look, any industry that's got 17,000 practitioners has the full range of what that experience is like for the consumer, and I'm sure that the within those 17,000, there are a few rogues who did try and maximize the size of the loan and did underestimate expenses and increase revenues. Sure, that probably happened, but the commissioner went as far as to say that brokers don't do anything to earn the trail commission, right? And so that was a very strong statement, and that came from, he was told that by Matt Coman of the CBA, and CBA would probably prefer not to have brokers in the market. So I would say that on a point that he missed, I think he missed the fact that a lot of brokers do provide an ongoing service. I mean, I spoke to one broker, and he says, ironically, one of the things I do is protect my client from the bank, because the bank can just increase its interest rates from the client on my client if they want to. That's what the contract allows a bank to do if it's not a fixed rate mortgage. And so I step in at that point and say to the bank, I think my client might be able to do better elsewhere. So I think it was harsh to say effectively no mortgage broker does anything to earn a trail. And a couple of other things which I'm happy to talk about in more detail. I thought industry funds came out of it really, really well. If you talk to the people from the industry funds, they will quietly say it's all we can do to keep a lid on our excitement. This has been wonderful for them. They are thrilled, and the fact that they're getting fantastic inflows shows it. But did he really answer a couple of questions that need to be answered about how do they value unlisted securities? What happens with the flow of payments to the union members who are on the board of industry funds? I'm not saying either of those issues is a problem. I'm simply saying it would have been good for Kenneth Hayne to explore them. And the final thing that I really started to get worked up about was legal people of all people complaining about charging fees to dead people. I mean, the legal profession specializes in charging fees for administering estates, and
demarcation issue, you think?
Well, who are they to say that there's no work involved with a financial planner when one of their clients dies? And so sort of this it sounds so obvious that that's terrible, charging fees to dead people, but it's not obvious. And in fact, the legal profession itself charges fees to dead people. So look, Kenneth Hayne did a fantastic job. He shone a light into dark corners, as they love to say, but it wasn't perfect.
And as you mentioned, there's plenty of fodder left, I think, for subsequent royal commissions. It just begets the question if and when those they may arrive. So look, thanks very much for the chat today, Graham. It was fantastic and highly illuminating on your experience and obviously your knowledge of bank culture and how that sort of is now portrayed perhaps now in the media through the Royal Commission, and hopefully we see some lasting change get put through by way of legislation, and perhaps some bolstering of our regulators as well. Perhaps if Labor get in and decide to really have a crack at it. How can our listeners continue to follow yourself?
Yeah, so thanks for that. So if you go to the Cuffelinks website, so Cuffelinks, so cuffelinks.com.au, it's a free weekly newsletter where we publish articles by market professionals, and we've published articles by Nucleus in the past. So that's the sort of person who writes for us. It's a free newsletter. You just go into the subscription box and just put in your name, and it'll come to you each week.
Wonderful. Okay, and we'll put a couple of links in the in our podcast end notes as well for your page. So on that note, thanks very much for your time, and we look forward to get you on the show again sometime soon.
Great, thanks for the opportunity.
Cheers. So, Damien, a fantastic little interview there with Graham Hand, 40-odd minutes, hearing from a guy that has plenty of experience in banking and also a firm grasp of the sort of culture to expect that we saw in the Royal Commission.
Absolutely. It's good to bounce our ideas, investment ideas, off somebody who is pretty closely involved with the whole process and there and writing about it all the time. So it some very interesting insights.
So what do you think the key takeaways were from an investment perspective?
Yeah, so there's I touched on it during the interview, and I think there's two key bits I'm focused on. First one is this effect on bank business models, and the whole part about the fact that there was no structural separation sort of mandated. I think there's certainly some indication that there are some areas they should be picking up on, but there was no it must be done this way, and these two cannot be put together. So I think in terms of that, that is a positive for the banks as a longer term investment model. As Graham alluded to, that there probably is a little bit less risk taking you'll expect, certainly over the next couple of years coming out of the banks. So you probably will see less innovation and potentially give up some market share to some other participants who haven't got as much regulatory oversight. So from that perspective, it's a bit of a plus and a minus in terms of net effect is the banks are going to be, broadly speaking, a more boring and safer investment. Having said that, though, that's the sort of micro view, and that's sort of all else, that it excludes all else. The bigger issue for me still comes back to this effect on lending, and I think for me to hear from Graham that so there's not a lot of pushback on my view that the banks are going to keep the credit quite tight until they get an actual outcome from the Westpac versus ASIC case, which is in progress at the moment. And so, my expectation is that credit will still be tight. You'll have prime ministers and RBA and all these various sort of places exhorting banks to get out and lend more. But at the same time, they've got this uncertainty hanging over them. And Haynes certainly made some pointed comments about responsible lending, and banks, they've got these requirements to make sure they comply with these responsible lending laws, which are criminally punishable if they don't, and that the culture in banks got far too much in terms of sales and not enough in terms of the compliance side, and so they need to lift it up. So I think until they get some certainty around that, we're going to keep seeing that constraints on lending, which is a very bad sign for the Australian economy.
Okay, so, sure.
Housing prices continue to fall, continue to see credit rationing, and there's not good macroeconomic outlook from that. So we're certainly, from a macro point of view, nothing changed in terms of wanting to be very, very underweight Australian stocks. And the effect on the banks is saying, well, you might have got away with a few things, but the bigger issue is what macroeconomic effects are going to have on yours. And as you start seeing, if house prices keep falling, then the bad debts are going to pick up, and you'll have some issues within the banks from that perspective. So yes, the investment looks better for the banks, but from our perspective, you want to wait until the macroeconomic storm, which is sort of lapping at the shores, has gone away before you start jumping back into those.
So from a timeline perspective, so we've had the Royal Commission now, recommendations have come out. Now it's really just a wait and see on a potential government change, what they bring in force in terms of the banks, the outcome of this ASIC investigation with Westpac, and then whether or not they can lend again.
Yep.
Parlayed into what the house price or the house market looks like in, say, 12 months' time when all the dust settles, and we've got to work out whether anyone actually wants a mortgage at that point.
Yeah, and look, 12 months might not be enough. If the court case ends up spiralling into further detail, maybe it lasts longer. But there's certainly a period of at least 6 months, you'd say, where there's still this uncertainty around, and until we see new governments and what they're going to do, I think there's if you're at a bank and you're worried about your position and certainly your legal position in terms of this lending, I think Hayne made it quite clear, and the answer would be to sit on your hands and be as conservative as possible to make sure what you're doing is in compliance with the law. Okay, sure. So just finally, I guess from a practical sense, bank positions in our portfolios looking tenuous at the moment? Yeah, so we're minimum weight Aussie banks, minimum weight Aussie shares. Okay. Happily put. Okay, There we go. Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers. Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation.